What if I told you that the same three firms are the largest shareholders in most major American corporations? Airlines, banks, tech giants, pharmaceutical companies, different brands, different CEOs, but often the same top owners. Today we're talking about the concentration of ownership in modern capitalism and the quiet dominance of three asset managers: BlackRock, Vanguard, State Street. Together they manage tens of trillions of dollars, but here's the key distinction. They don't own this money in the traditional sense, they manage it. Most of that capital sits inside index funds and ETFs. When you invest in an S&P 500 index fund inside your 401k, you're typically investing through one of these firms. Index funds are passive. They don't try to beat the market, they replicate it. So if a company is large enough to be in a major index, these firms automatically become major shareholders. That's where the concentration begins, because when you add up the shares they hold across funds, these three firms are frequently among the top institutional shareholders of the same companies, even competitors. Airline A and Airline B, Bank A, Bank B, Tech Company A, Tech Company B, separate firms, shared owners. Now, to be precise, this is not a secret cartel meeting in a dark room. There is no phone call coordinating prices, but ownership concentration changes incentives. If your largest shareholders own stakes in your competitors too, aggressive price wars don't necessarily maximize overall portfolio returns. Stability does. Industry-wide profitability does. The incentive shifts subtly, from beating your competitor to preserving margins across the sector. That's not conspiracy, that's portfolio math. There's another layer, voting power. These asset managers vote on corporate governance issues, board appointments, executive compensation, shareholder proposals. Because they hold such large blocks of shares, their voting influence is enormous. Now they argue they are passive investors, and in many operational respects, they are. They're not running day-to-day management, but concentrated voting power means they sit at the center of corporate governance across the economy. Three firms, trillions in managed assets, voting stakes across nearly every major public company. Supporters say the system is efficient. Low-cost index funds democratize investing. Millions of ordinary people gain exposure to diversified portfolios. That's true, but concentration is also real. When ownership consolidates at scale, systemic risk consolidates too, and influence consolidates. If capital allocation decisions, governance norms, and shareholder priorities are filtered through a small number of institutions, the structure of the market changes, even if competition on the surface looks intact. Here's the broader implication. Modern capitalism doesn't run on competition. It runs on asset management. Ownership is layered, diffused at the retail level, but centralized at the institutional level. So when you hear that companies are independent actors battling in free markets, that's operationally true. But at the ownership level, the web is much tighter. This isn't about villains, it's about structure. Indexing created enormous efficiency. It also created unprecedented concentration. And when three firms sit at the crossroads of most major corporations, the question isn't whether they control everything. The question is simpler. What does competition really look like when ownership is shared? Because in modern markets, power isn't always loud. Sometimes it's structural.